Okay, right. So let's sort of move on from historical costing. We sort of move on to this next method, which sort of says, listen, we should try our best to get things as current as possible. So it sort of says, okay, you know what? We will have typically you will have RPIs. I mean, you just have to understand this conceptually. It's just conceptually that as opposed to you're not going to prepare any accounts or you're adjusting the events. But again, like I say, as historical accounting has been criticized for providing information that is out of date. Um, it potentially understates asset values. And so there are two options in terms of how do we get the accounts to look a bit more current. So we have the first option here where it says here's the current purchasing power, which I will look at. So the current purchasing power sort of says, you know what we have to do here is that let's adjust the financial statements to take account inflation, to take inflation into account, so that we can try and maintain the, if you like, the value of the events happening, to take account to make sure we include the effect of inflation, if you like, in that, because typically these assets lose value where we have inflation. So it says here that a general price index is used, applying a general, I think those are the key issues here, a general level of inflation. So figures in the statement of profit or loss and statement of financial position are adjusted by the CPP, by the if you like, the factor, if you like, the index that we intend on using, the constant purchasing power factor, if you like. So it's like anything. It's like, I suppose the question here is that if you're going to start with an index of 100 and you're going to say that the index has gone from 100 to 105, really the increase is 5%, and then the next time you have 108, so you really have is 108 growth on 105, if you like. So that's the growth from period to period. And that's how we fundamentally deal with that. So basically, this is really saying, in order to maintain, for these assets to maintain their constant purchasing power, what we need to be doing is adjusting them, if you like, for inflation. Now, of course, there's sort of two issues here. This is sort of this issue with monetary items and non-monetary items. And monetary items, of course, we know they are fixed by contract, and otherwise, in terms of, if you like, in terms of numbers of units of currency, regardless of changes in general price levels. So, I mean, this is just a general concept. I think it's just generally understanding what's going on here. And some of the examples you see, like cash and receivables and payables and loan capital, these won't change, if you like, in terms of inflation. You cannot. That's the problem with these monetary assets. They're the ones that will suffer. Well, when I say monetary, yes, the monetary assets that you're holding will suffer. If you have £1,000 in the bank, and you can, I guess the idea, buy, say, for example, a machine that's £1,000 at the end of the year, and this is the beginning of the year, and you still have only £1,000. Say you have interest of, I don't know, 1,000 of 5% over the year, and inflation has actually increased, where you would actually need, say, inflation has increased by, I don't know, when I said 5% here, say, yeah, 5%, that would have been 50. Say inflation had increased by 10%, so you would need 1,100. So now you don't have enough to buy that machine because inflation has increased by 10%, but your interest in the bank has only increased by 5%. So there's nothing you can do. This will just remain in the bank. The bank doesn't give you more money to account for inflation, so you can't really account for that. You have to leave that alone. But so these assets, unfortunately, the assets stay the same. But in the same vein, it works in your favor, of course. So holders of monetary assets lose general purchasing power during a period of inflation, to the extent that any income from the assets does not adequately compensate, of course, for the loss in purchasing power. And of course, the converse applies to those having monetary liabilities, of course. So if you owe £1,000, and if you like, that's all you have to pay, even in a time of inflation where you really should be paying more, so to speak, but you're only going to have to pay £1,000 despite inflation. So that's an advantage, if you like. The person who you lent the money to is the one who's suffering, if you like, this. Because when they get £1,000 from you, they won't be able to do as much as they could when they lent the money to you. So, to a certain extent, it works in your favor. And so, but with non-monetary items here, the idea really is that with non-current assets, this just makes sense that these assets do increase. They do increase with that value of inflation, right? Because that's the thing about inflation. It actually is in the value of the asset itself. So if you hold it at historical cost, you're assuming there is no gain or loss. But typically, what would happen is that you can increase it by the inflation index, and that's how you deal with that. And equity really is the difference, isn't it, between assets and liabilities? So it's not really about applying any sort of inflation to it here. So it's simple and objective. It relies on a standard index. It adjusts for changes in the unit of measurement, and therefore is a system of inflation accounting. And it measures the impact on the entity in terms of shareholder purchasing power. So again, the problem here is that we're sort of assuming a number of things. We are assuming certain specific and general price movements. We're just using these general price changes. That's the first thing. And typically, of course, this still does not show the current value to the business of those assets and liabilities. We're just working with this index. And the general price index may not be appropriate for all assets in the business. And we'll come to discuss this meaning of the physical capital of the business really. In the end, I mean, this is not maintained, but we'll talk about that when we talk about physical capital. But so the key point really here is that CPP says adjust these assets for inflation fundamentally, but leave the monetary assets alone. It won't make any sense adjusting those for inflation. They are what they are, and unfortunately they suffer, or on the other way, gain. Depending if you're holding assets, you suffer. If you're holding liabilities, you gain an advantage. Right. Then the next method, if you like, the current cost replacement method, is literally real live current value. It's saying recognize this thing at its current value. So you're going to be hitting your income statement with some losses. So the key features here is based on the deprival value of the value to the business. So this is really equal, the deprival value is equal to the loss suffered if you were deprived of the asset, and is usually represented by the replacement cost. So typically inventory and non-current asset are valued at the deprival value. So first of all, what they're saying here is we don't adjust, of course, these cash, receivable, payables. Don't touch them. Leave them alone. But if you've lost any value here on your inventory or whatever it is, you need to recognize, if you like, that loss. On your assets, you need to recognize that loss if the current value that we're dealing with, so current value being replacement cost, if there's a fall in value, you need to recognize that loss through your income statement pretty much. Because if you like I say, we're using a current value here. And so, but again, this varies if you like. So current costs, replacement cost is not a single system. The key point is some books will talk about net present value as the replacement cost. I've talked about it from that insurance point of view. But in general, in principle, we're looking for a current value. Remember the CPP was about inflation? No, we're now saying what's the current value? Let's get as good a current value as it should be. And if there's a change, hit your income statement with that. Hit your income statement with that, with those losses. So the current cost statement is charged with the value to the business consumed during the period. And whenever we have those falls from historical to current, you have to put them through. You have to put them through. There is a relevance, isn't there? There's a relevance here, and users will be able to assess the current state or recent performance of the business. And it talks about this business of physical capital being maintained, and assets are stated at their value to the business. It is complex. It's again, greater subjectivity. And it only adjusts the non-monetary assets, not all the assets. It doesn't deal with the monetary assets like the cash and trade receivables and trade payables. And again, I think finding an index, this is the problem. It's very difficult to find an index for most of these things. So I think, again, like I say, it's just conceptually that I think you want to understand what's going on conceptually. I think that's the main point. Yes. So so here we are. So it says here, describe those businesses that would be heavily affected by replacement of historical cost with current values. So literally, if you have an asset that's sitting there, and you want to start replacing with the current value, if the cost is really high, and you're going to be putting through, so basically, if you're going to be going through a major degree of impairment from historical to current value, is where you will suffer. So large quantities of inventory held for long periods of time. So if you can see that you've been holding that for a long period of time, so chances are that you have impairment here. So the current value is much less. So that's the first thing. So you need to adjust that. The other thing here is high levels of non-current assets acquired a long time ago, um, and you haven't adjusted, if you like, appropriately. Once you carry out the right adjustment to current value, a further depreciation that will hit your income statement as well. Um, High level of monetary assets. A charge is made to the statement to reflect the fall in the value when prices are rising. High levels of borrowing. Um, a credit is made, if you like, to reflect the beneficial effect of borrowing in inflationary times. So actually, kind of going back on what I said there, we do put through an adjustment when we're dealing with the, if you like, when we're dealing with the current cost accounting. When we're dealing with the CPP, yeah, we actually put through those adjustments. I mean, in what I really meant was that in practice, really, and because this is very open, it just doesn't make it just seems strange putting journals through. In reality, putting a journal through to show the change in the value of your money. But in principle, right? In principle, if you have a fall in the value of your funds, you can put through an expense and of course a gain, so to speak, as a result of your gains made on um, your monetary assets. So remember, there are two issues we're dealing with here. We're dealing with CPP and we're dealing with current cost and current cost accounting here. Right. So yes. So here we are. So this is just talking about the current values in general, but there we are. So current cost accounting, but in general, we remember, like I said, with current cost accounting, we do not touch. Here we are, just to highlight that point. Here we are. It says that current cost accounting. Remember, we don't, in general, touch the monetary assets. That was the inventory and non-current assets are valued there, and I just want to highlight monetary assets are not adjusted with current cost accounting, but with CPP we adjust them. Okay, right, and that's what this applies to. So this is just an open question. This really applies to CPP because we don't adjust anything in CCA. Okay, great stuff. And let's finish off here. I think I can finish off in one final video really here. Capital maintenance. So this is important. We get little questions on this here, just in terms of theory. And there has to be a focus on, there's this focus on dividends here and maintaining the operating capacity, I think I like to put it, of the business, here. Yes, please. So try and let's just sort of endure this very last bit. So capital maintenance concepts are very much about maintaining the operating capacity of this business, right? And and I put a focus on dividends so you can see where I'm going. So we have two issues here. We talk about physical capital maintenance, alternatively known as operating capital maintenance and financial capital maintenance. Let's look at physical capital maintenance. This is typically associated with current cost accounting. So the key point here is that we're making sure that we can continue to operate at current levels of activity. The problem is we suffer inflation, right? And if you're not careful, you could give out more dividends than you really should, because if you have inflation, you want to make sure you have enough money around to be able to still buy the same amount of goods. Remember that these goods have gone up in the prices have gone up. So yes, you've made monetary amounts, but the real amounts, you're actually weaker. Let's see. This means, therefore, adjusting opening capital by specific price changes. Let's look at an example here. If a business starts on the 1st of January with contribution of £1,000 from owners, and then what they do is, like whatever you have is equal to C, so 1,000 here and 1,000 here, and they use all this money to buy some goods. They buy 100 units at £10 each. So they buy expenses, of course, for 1,000. And then they now sell, of course, everything for 1,100. You now have 1,100 in the bank. So you have profit of £100. So opening capital is 1,000, closing capital. So when you bring the E here, of course, you now have, of course, profit of 100, don't you? So opening capital is 1,000, and closing capital, when I bring the E over here, I will subtract 1,000, and this will be 100, and I will put 100 here. So basically, I'll have 1,100 here and 1,100 here. So opening capital is 1,000 and closing is 1,100, and profit will be 100. However, over the year, the price of the units have increased to £10.75. So now that's the problem, right? Because if I was to go out again, so what we have here is a price increase of 7.5%. 7.5%. So what are we saying here? So really, we're saying that if I was to buy the same goods that I started off with, let's just go back there. Remember, I bought 100 units. If I want to just literally trade again next period, I'm going to need to spend 100 times £10.75, right? So just showing that over here, £10 times £10.75, and therefore what I'm going to end up spending, if you like, is £1,075. So really, again, 100 units and £10.75, I'm going to end up spending 1,075. So really and truly, right, if I'm going to carry on just operating, I cannot give out this full £100. It won't make any sense. I won't have enough. If I gave that away, I won't have enough to carry on trading. That's what the argument is. So in order to maintain my ability to trade, I can only give out £25 as a dividend to make sure I have 1075 to buy exactly the same number of units I bought the last time, if you like. And so the argument, and that's the argument really, is sort of saying that that this is what I need. I need 1075 in order to actually continue trading. So I'm very much aware of the productive capacity of the business and the physical capital, or the physical ability of the business to carry on trading at its original point, or what it traditionally does, is this idea of physical maintenance. Physical maintenance. That's the point. Right. Okay. That's that first one. And then this is the second point here. And financial capital maintenance now sort of says what we need to do is there's two options. You can set aside profit in order to preserve the value of shareholder funds in either monetary or constant purchasing power. So let's sort of see what they're saying here. We can measure, so for example, this business starts we can do it in two ways, just pure monetary terms, which is not real, it's just a monetary item. You can talk about maintenance in that, or really real, which is what you probably want to think about it in. So business starts 1st of Jan, contribution of that, like we did before, you have that, you sell for 1,000, so profit is £100. So inflation over time makes it difficult, but we use this resale price index. And if inflation is 5%, what are we really saying? We're really saying here that, ultimately, that you've had this inflation hit you, and if you like, in order to really keep the power of your currency, what you need to do is you need to store in, if you like, your 1,000, your so-called £1,000 equity isn't really 1,000. Really, you need to increase your opening capital by 1,050 to keep up with this inflation, to protect you, so that in a time of inflation, your capital continues to maintain its value. Right? So this is referred to as financial capital maintenance. So it means you can only really and truly give out profit of £50, because we need to make sure that our profit in effect is in line, or is indexed with inflation in effect. That's what we're doing here, and that's what we're really doing ultimately. And this is the constant purchasing power. Method. The monetary method would just have said, listen, let's leave it at 100, but you know really and truly that your profit isn't really 100. There's inflation of, if you like, 5% on your capital that you had to consider. And when you consider that, you will then kind of deduct that. So using your monetary method, you will say your profits were 100, but using your constant purchasing method, you would say your profits were only 50 because you had to cater for 5% inflation in your capital to make sure it could carry on year. Cool, great stuff. Long and rather tiring chapter, full of theory. But hopefully, when we do some questions, we can then see the application of this as we go along. Okay, and that's the end of chapter 7.